All right, let's get right into it. There's an investing strategy out there born from Nobel Prize winning research that has pulled in over $1 trillion. It's called factor investing. But here's the thing, there's a massive problem hiding just under the surface, a problem that's causing this smart strategy to fail millions of investors. So today we're going to break down what went wrong and why this so-called smart money isn't so smart anymore. First, let's just wrap our heads around the scale here. This number you're looking at, $1.56 trillion. That's how much money is currently in what are called smart beta ETFs. You can think of these as funds open to literally anyone that are just programmed to buy stocks with specific traits, like being cheap or having strong momentum. It's an absolutely staggering amount of cash, and it's all chasing the same handful of ideas. And that leads us to the big question, right? If the strategy is so brilliant and so popular, why hasn't it been working? Well, the data doesn't lie. It's pretty stark, actually. Over the last decade, 4 out of the 7 major single-factor indexes have actually underperformed the global market. They failed to do the one thing they were designed to do, beat a simple, plain vanilla market index. To really get why this is happening, we've got to go back to the beginning. See, factor investing wasn't dreamed up in some marketing department. It came straight out of decades of groundbreaking academic work that totally changed how we think about what drives returns in the first place. You can see the whole story laid out here. It all kicked off back in 1964 with a simple model that said only market risk mattered. But then in '92, 2 researchers, Fama and French, completely changed the game. They showed that other things, these factors, like a company's size and its value, could explain returns way better. And from there, the models just got more and more sophisticated, adding in things like momentum and profitability. So what is a factor really? Well, in simple terms, it's just a shared, measurable trait of a bunch of stocks that helps explain why they perform differently than the rest of the market. You can almost think of factors as the fundamental DNA of a stock's return. Let's look at a few of the big ones. Okay, first up, we have value. The idea here is pretty simple. Buying stocks that are cheap compared to their fundamentals, like their price-to-book ratio, has historically led to better returns. It's classic bargain hunting. But man, has it had a rough decade. Just catastrophically bad. Mostly because a flood of money chased this idea right as a few huge, expensive tech stocks took over the world. Next up is momentum. Now, this one is interesting because it kind of puzzles the academics. It basically just says that winners keep on winning. Stocks that have gone up recently tend to keep going up for a while. It's this persistent little quirk in the market. And in 2024, it's actually been one of the strongest factors out there. And that brings us to quality. This is the idea that good businesses, companies with stable profits, solid financials, tend to make for good investments. And what's really crucial to know here is that long-term data shows quality has been the most consistent factor of them all, delivering extra returns in all sorts of economic environments, going all the way back to 1963. So we have all these academically proven factors that are supposed to give investors an edge. But this is where our story takes a sharp turn, because the very popularity of this brilliant idea has created a huge unintended problem, and it's the main reason the strategy is breaking down for so many people. This quote just nails it perfectly. The whole problem can be boiled down to one word: crowding. When an investment strategy goes from being a niche academic idea to a multi-trillion-dollar global trend, its very effectiveness gets put in jeopardy. Let me put it this way. Imagine your navigation app finds a secret little side street to get you around a huge highway backup. It's a genius move, right up until every other navigation app sends thousands of other drivers down that exact same street. All of a sudden, your secret shortcut is the new traffic jam. That is exactly what's happened to factor investing. And hey, this isn't just a clever analogy. You can see it plain as day in the data. Researchers figured out how to measure how crowded stocks are. And as you can see on this chart, they found a super clear pattern going all the way back to 1997. The more crowded a stock is, that's the bar on the left, the worse it performs. The traffic jam theory holds up perfectly. Okay, so the problem is pretty clear. Crowding is just crushing returns. But that doesn't mean the game is over. The real question is, how do you navigate this new reality? The good news is, there are specific strategies you can use to deal with this problem. First things first, do not put all your eggs in one factor basket. Just look at these numbers. A pure value strategy, at its worst, saw a gut-wrenching drawdown of nearly 40%. But a diversified, multi-factor approach, it cut that painful drop by more than half. That's because different factors often zig when others zag, and that helps smooth out the ride. So this all leads to two key ideas. First, you've got to diversify your trades. Think about it. When a momentum fund is selling a stock that's run out of steam, a value fund might see a bargain and start buying it up. They're basically creating a market for each other. This cuts down on costs, and get this, some research shows it can boost profits by as much as 22%. Second, choose sophistication. The simplest factor strategies are like the main highways. They get jammed up the fastest. More complex approaches that are harder to copy are way less likely to get stuck in traffic. So let's put this all together. What does this actually mean for you? Well, if you want to use factor investing today, you can't just buy a simple ETF and call it a day. You need a clear set of rules, a playbook, to guide you through this new, much more crowded world. So here it is, your playbook. Number 1 is absolutely crucial. Diversify across multiple factors so you don't get torched by just one. 2, you have to be patient. You have to accept that even great strategies can look bad for years at a time. 3, it now really pays to monitor how crowded certain trades are and maybe avoid the most overhyped ones. 4, watch your fees. When potential returns are lower, every little bit you pay in costs matters so much more. And finally, number 5, make sure the factors you pick actually line up with your own personal investment goals. And all of this leaves us with one last big idea to think about. In a world where any great idea can be copied and crowded out almost instantly, maybe the only truly sustainable edge isn't some smarter algorithm or some secret new factor. Maybe it's just the discipline and the patience to stick with a solid plan through the tough times, long after everyone else has gotten scared and moved on to the next shiny object.